Hello and welcome to this month's webinar. We are going to discuss the fundamentals of investing. There's been obviously a lot of volatility in the equity and fixed income markets and a lot of bad headlines, negative headlines coming out of the news. And we thought it would be useful to take a broader perspective and really look at what drives investment performance over time rather than just focusing on kind of the vicissitudes of the market on a daily basis. A couple disclosures. This information is solely for informational purposes, and past performance is no guarantee for future returns. Also, securities mentioned in this webinar do not constitute a solicitation to buy or sell. Please consult with your financial professional based on your individual circumstances before making any purchases based on this webinar. So what are we going to cover today? We're going to start with what is investing. We'll talk about different approaches to investing, what game we're playing, the difference between the stock and the bond market, provide some market context and historical perspective, talk about valuation, the stock versus the underlying business, Mr. Market, using volatility to your advantage, the psychology of investing, coming up with your own game plan, and finishing with diversification and asset allocation. So what is investing? Delaying spending a dollar today to increase the buying power of that dollar in the future. In other words, giving up something today with the intent of having more in the future. How much more and over what time period dictate the appropriate investment strategy. Approaches to investing. What game are you playing? So I would broadly classify investing into two groups of people or individuals. There's your buy and hold long-term investors, and there's your traders and market timers. And what's important to recognize is you can have both groups of investors invested in the same security, but they're playing very different games, right? A trader is looking to get in and get out on a short-term time frame and make money over that short-term time frame. A long-term investor is really in a stock or a fund for multiple years, and they're invested over a much longer term time frame. And it's really important to recognize as an investor, which game are you playing, right? Because when the market's as volatile as it is and sentiment is driving the daily moves in the market, it can over time lure longer term investors into a shorter term mindset. And we believe a lot of that is starting to happen today. Typically, I would say bubbles and panic occur when masses of investors switch their mindset from a long-term mindset to a short-term mindset. So what is the stock market and what is the bond market? What are the differences between them? Remember that when you own stock, you actually have ownership of a business, right? The stock market is a collection of publicly traded businesses, and their ownership is divided into shares of stock. So as an owner of that business, you share in the future profits or losses of that company over time. Some of those profits may be paid out to you as dividends as a shareholder. And the key thing to remember when you own a stock is there is a much greater inherent risk, because there is no promise by the company to return your capital. You're an owner, and so your capital is at risk. The stock price, right, reflects what investors think the business is worth at a singular point in time. The bond market, on the other hand, is where you're loaning money to the company or to a government or to an organization. So it represents debts that companies or governments owe bondholders. Bonds typically are issued with a set coupon, which is determined by interest rates, the credit strength of the issuer, the time period until the principal is paid back to the bondholder. So bond prices will move up or down as a function of interest rates primarily, and also the function of the risk of the issuer being able to pay back the debt. So in this case, there is actually a promise, a covenant from the company, the issuer, to pay you back your money over time. So generally speaking, right, in aggregate, bonds are going to have less risk than stocks because there is the whole purpose of the bond is to pay you interest and then your principal back at the end. Whereas with the stock, you're taking ownership in the company, and so it really depends on how the company executes and market forces, industry forces, and competition over time. And we also need to talk about understanding the Federal Reserve's role, especially when we're talking about interest rates. And especially right now, given the Federal Reserve is on a quantitative tightening cycle. So the Federal Reserve controls the amount of money in the financial system through quantitative easing and quantitative tightening. And these are very powerful forces in the market. And they provide liquidity, sometimes in a big way, that can drive prices higher, or with the withdrawal of liquidity like we're seeing now, it can drive prices lower. So the Fed is in the midst of a tightening cycle with the goal of taming inflation, which is currently at a 40-year high coming out of the pandemic. Rising interest rates are inversely related to bond prices. So one of the most challenging things about 2022 from an investment perspective is typically when stocks decline, people seek safety in bonds, boosting the prices of boosting the prices of bonds, sending yields down. But in 2022, we've actually had a sell-off in stocks, and because the Fed is raising interest rates due to inflation, we also saw a dramatic decline in bonds in the first half of the year. So you have a situation where the risk-free rate, or the yield on treasuries, is the percent return an investor can obtain. And that serves as a really valuable benchmark to look at the menu of different investment alternatives. And what we notice here is in the summer of 2020, the 10-year treasury yield was at 1%. It now yields a little bit north of 3%. That's a dramatic shift in a fairly short time frame, right? Stocks now need to earn more than 2% more per year to compensate investors. The speed and uncertainty of that interest rate direction has been the primary driver of the stock market decline so far. So again, we're looking at data going back, 6, 7, 8 months so far in this presentation. And I think it's really important to provide some market context and historical perspective to better appreciate what we're going through and how patient we might need to be. So if we look back, if we really zoom out and we look at $1 invested 100 years ago in the S&P 500, if you just invested it and then forgot about it and somehow lived to 100 more years, that would be worth $25,201.84 today. A massive increase, right? Put another way, if you invested $40,000 100 years ago, you would be a billionaire today. The stock market has returned about 10% on average per year. About 4% of that has come from the form of dividends, where companies have paid out their profits to shareholders. Along the way, you would have had to endure the following: the Great Depression, World War II, Cold War, Vietnam, Arab oil embargo, stagflation of the 1970s, Black Monday in 1987, dot-com bubble, 9/11, Iraq and Afghanistan war, the global financial crisis, and most recently, the COVID-19 pandemic. You would have also had to endure 15 recessions. There would have been 10 drawdowns in the S&P 500 that it would have exceeded 25%, about 1 in every 10 years. The smallest of those 10 drawdowns that exceeded 25% was 28%, and the largest was 83% during the Great Depression. The Great Recession, which was probably the most, the most recent salient event where we really felt, people were really think the world might end, occurred between October of 2007 and March of 2009. And that represented the second largest drawdown ever, which was a 57% drawdown. Now, during each of those drawdowns and each of these historical events, there are many people who thought that this was basically the end, that they were going to lose all their money. And in many cases, they had to endure very significant, losses, at least on paper, and not sell in order to receive the benefit of these long-term returns that we're talking about, like the 10% per year. That, of course, doesn't mean that that's going to happen in the future. It just means that if we look back over history, the capitalist system that we have in place has benefited long-term investors very, very well. And I think if you think about the world from a probabilistic standpoint, it's not to say it's definitely going to happen in the future, but the longer your time horizon, the more the odds are in your favor that you're going to have a positive return, and that return is going to compensate you for the risk that you're taking. About less than every 2 years, the market declined on average 10%. So clearly, the volatility we're experiencing today over the course of this year never feels good. It's quite painful at times. It's fear-inducing. The news outlets and what you hear from the media certainly doesn't make it easier. It makes it harder to endure. But the reality is actually what we're going through now is not uncommon. It's happened many, many times over history. It just so happens that from 2009 basically to 2022, we've been in a fairly uninterrupted bull market. Some more market context and historical perspective. You can see here, these are examples of reasons going back in time of concerns that the world had, investors had, reasons not to invest, and then the subsequent return from that time period through the beginning of 2022. You had Y2K in 1999, where people thought when the year 2000 hit, the market would, the computers would go haywire and everything would reset. You did have a significant bubble burst during the technology bubble of 2000, where you had a lot of the dot-coms came and went. But even there, even if you look today, if you invest in 2000, you would have a significant return, and on we go. The global financial crisis at the beginning, your money would have, almost gone up 5 or 6 times from that point, 300%. So you can see here that the longer the time horizon, the greater the returns, and there's always something that can be pointed to as a reason not to invest. And our baseline position is that this time is really no different. It's going to be volatile. Doesn't mean we couldn't go down more, but you only have so many alternatives to choose from, right? You can keep your money in cash, you can keep it all in your home, you could have it in bonds, you could have it in stocks. And we still think that having a diversified, balanced portfolio, again, from a probability standpoint, gives you the best chance at long-term success of, outpacing inflation and increasing the purchasing power of your dollars. Another really important principle of investing is focusing and understanding valuation, right? Valuation is a very important driver of return. The price you pay and the price that you pay for a security, and then the price when you sell, right? That's going to be a major driver of return. And the other thing we would say here to point out is we get a lot of clients who don't want to buy a stock because of the price of the stock, how much it trades for per share. And what we would say is that that's a little bit overly simplistic, because you can look at a company like Berkshire Hathaway, the A share. Warren Buffett is the CEO and chairman, been running the company since 1965. He's never split the A share. And when he started out, it was sub $100, and now it trades for close to $500,000 per share. But that doesn't mean just because it trades for that much per share, it's expensive. You have to look at the price of the share times the number of shares outstanding, and then compare that to the book value of the company and the earnings the company earned over the last year and is projected to earn over the next year. And then you can make a determination of whether you think it's overvalued or undervalued relative to the market. But all else equal, the higher the price you pay relative to the earnings of the business, the lower the returns are going to be on average going forward. Also, most of a company's value is derived from cash flows it's going to generate 3 years out into the future and beyond. So in other words, years 3 through 20 carry a lot more weight in terms of value than years 1 through 3. However, when you have times of heightened uncertainty, inflation, you still have a pandemic, you have a potential world war that's going on with Putin's war in Ukraine, that dramatically reduces investors' estimate of what the business can earn in those out years, right? Resulting in those sudden and steep sell-offs. People want to know, what are you going to make and how are you going to do over the next 12 months? Who knows where the world's going to be in 3 years? And conversely, when in times of relative calm and the Fed being, more dovish and easy with interest rates, the market will often overestimate what a business can earn, which results in loftier valuations. And this really is where I think we'll talk about this in a bit, where the psychology of investing is just so important. When things feel safe and there's relative calm in the world, people feel comfortable investing, but generally they're investing at higher valuation levels. That doesn't mean you shouldn't invest. It just means that there can be a false sense of security. And when there's more fear in the market and things are heading, things are trending downward, there's more, people are more resistant to invest because they feel like, well, why would I invest today if things are heading down? Historically, those have been the times that have been the most opportunistic to invest, where you have the highest forward returns. Again, not always. You can certainly buy in when things are bad and they can get worse. But again, when in the investing world, you have to think in terms of probabilities, because there is, by definition, no certainty. And when the odds get stacked more in your favor, that's when you want to try to be a little bit more aggressive. So let's look at a valuation example. Again, this is for illustrative purposes only, but we can talk about a company everyone's heard of here, Apple. In January of 2016, Apple traded at a valuation of 10 times next year's earnings. In September of 2020, Apple traded at a peak forward PE multiple of 35 times next year's earnings. In other words, same company, but investors were willing to pay 3.5 times as much for $1 of Apple's earnings in the span of 4 years, right? So clearly in January of 16, there was a lot of pessimism about the future of Apple and how it would fare over time. And in September 2020, you could argue there was kind of peak optimism about how it was going to fare going forward. So what happened over that time frame? Well, it was a massive shift in expectations. And the reason is because in 2016, there was a decline, or an expected decline in net income and cash flow. The stock was coming off 2015, where it did 81 billion in cash flow from operations and was forecasting a drop in 16. That caused the valuation multiple to contract 33%, going down from about 15 to 10 times next year's earnings. The cash flow from operations did in fact drop from 81 to 66 billion over the course of 2016. But then over the next 6 years, Apple grew cash flow from operations from 66 billion to 116 billion, if we look trailing 12 months. So you had tremendous volatility around the stock price because of those shift in expectations. But the actual cash flow that Apple generated was fairly stable and growing over that time period. So how about the market today? Now, this is as of May 20th. It's come back a little bit since this time period. But you can clearly see, the long-term average going back to the 80s is about, the S&P 500 trades at about 15.5 times next year's earnings, right? That's a long-term average. Now, that has been there's been periods of time where it's traded under that, and then there's been periods of time during, lots of optimism where, like in the late 90s, where it traded significantly above that. Coming out, during the pandemic with very easy monetary policy and a lot of fiscal stimulus, you saw valuations, get to pretty frothy levels. And a lot of that is now unwinding as the economy is opening up and inflation and interest rates are going up. But we're at, I would say, a much more reasonable level now than we were a year ago, when people were much more comfortable and optimistic investing in the stock market. So, it just goes to show you that, the market moves on a pendulum, and it's when it's going to the upside, it oftentimes swings too far to the upside, and on the downside, it can swing too far to the downside. It's just the nature of how the markets work. Another important principle here is to understand the difference between the stock and the underlying business, right? The stock is the ticker you see, the price moving across the screen on a daily basis. And it's just trying to track the underlying business. But clearly a business, especially a multi-billion-dollar business, just think to yourself, does it make sense that this business would be increasing or decreasing 10, 20% value over the period of a day or a week or a month? Possibly in some circumstances, but unlikely in aggregate that's really happening. It's pretty absurd when you think about it. So it's really important when you're looking at your portfolio or you're looking at the market, that even though it can feel like the value of our portfolio that we see on the screen is equal to what's actually happening to the underlying businesses it holds. Oftentimes I would say normally that's not the case. It's when things are going up, especially during periods of great optimism, it's probably not as good as it looks. And then when things are, on the way down, there's points in time where it looks a lot worse than it actually is. So I think one of the quotes from obviously one of the greatest investors of our generation, Warren Buffett, he said, in the short run, the market is a voting machine, but in the long run, the market is a weighing machine. And that's exactly what that means, right? In the short term, stock prices are driven based on sentiment, macroeconomic events, but in the long term, it's based on what does the company generate in terms of earnings per share over time, cash flow per share over time. If the business does well over time, the stock is going to follow suit. So let's look at an actual example of the difference between stock and the underlying business. This is again for illustrative purposes only. Microsoft, a company, again, I think everyone has heard of. You can see the blue line represents the free cash flow that Microsoft has generated going back to July of 2019. And you can see that blue line, right? That's actually what the business is generating in terms of cash flow. And it's, it has some gyrations, but for the most part, it's fairly stable and up and to the right. Conversely, if you look at the jagged red and black lines, that is the movement of the price of Microsoft stock going back to July 2019. And you can see there that there's a lot more volatility around the price of the stock versus what the underlying business has done. And if you look kind of in the most recent, going back to the beginning of January, end of 2021 here, we've seen this not just with Microsoft, but a number of companies, is that the valuation has, and the stock price has gone down, even though the free cash flow has largely, continued that upward trajectory. And so this is, I just think, a really good example of where if you're paying attention to just the price of the stock, you're going to feel pretty disenchanted about, your holding. But if you're looking at the underlying fundamentals of the business, the cash flow it's generating, it looks pretty, it continues to look strong. And again, over long periods of time, if this blue line continues to trend upward and to the right, the stock price over time will naturally follow. So, again, it doesn't mean that, the movement in the stock price can't be right in time. Maybe Microsoft will decline, but you shouldn't let the price of the stock inform your, how you feel or your confidence about the future direction of the company. You have to look at the underlying financials of the company. So again, that's just a really good example of the difference between what the stock is doing and what the underlying business is doing. So Mr. Market, right? Understanding market volatility. You want to think of Mr. Market as a moody drunk who comes to your house every day and offers to buy it. You don't have to sell it, but every day Mr. Market will come and make an offer. Sometimes the offer will vary wildly depending on his mood. You want as much as possible to divorce yourself from Mr. Market's mood in your decision to sell, right? And this is where investing becomes more psychological than analytical. There are few things regarding the market investing that you can control, but one of them is when to sell. And just like, you wouldn't pay much attention if someone came to your business or your house and offered you a price to sell every day, it shouldn't be any different with the market. I would admit that it's much harder to ignore because it's in our face all the time, and we see it in the news and friends and family talk about it. But the reality is that unless you need the money today, it doesn't really, it shouldn't really impact your long-term investing decisions. And that's why we focus so much on the financial plan and your time horizon and your liquidity needs, so that we can craft a portfolio that makes sense for you, for your financial goals and for your time horizon. I think one of the most, the least talked about and most important parts of investing is the psychology of investing. Peter Lynch of the Magellan Fund, who's the legendary portfolio manager of the Magellan Fund, said in the stock market, the most important organ is the stomach, it's not the brain. And that really is because no matter what stocks you own, there's going to be a period of time where they're down significantly. You can look at any stock in history. It's if you're on a long enough time frame, you're going to have to withstand pretty significant drawdowns. And if you don't have the conviction, right, the stomach to endure those drawdowns, then you're never going to be able to benefit from the upside, those higher returns when eventually the company comes back. So your behavior is actually, in our opinion, the biggest driver of investment results, not your knowledge level. And successful long-term investing requires us to override a deep neurobiological wiring to survive, right? That comes from millions of years of evolution. If you don't believe me or that sounds silly, think about this. If you were to look at your portfolio right now, does your body, your mind have any reaction? Tightening in the stomach, feelings of frustration, disappointment, anger, sweating, racing thoughts of what if scenarios? And when you looked at your portfolio at the end of 2021, when the market was at a high, well, my guess is that your reaction was far more muted. Kind of like, oh, good, it's up from last month, we're trending in the right direction. We are wired as human beings to react to perceived danger, not to positive news, because it affects our survival from an evolutionary perspective. But in the investing world, to be a successful investor, you almost want to flip that on its head, right? You want to try to be aggressive when there's a lot of fear out there, and you actually want to be more cautious when there's a lot of, when optimism turns into greed. Easy to say, very hard to do, but you always kind of want to try to be almost going against the grain in terms of your psychology and to remain balanced. So the psychology of investing, this chart, you probably have seen something like it before. It's true, going back to 1900 as it is today. Price on the y-axis and time on the x-axis. A bull market is started in disbelief. It gets traction on hope. It starts to really take off on optimism. Then you have belief, thrill, and it point of maximum financial risk is during euphoria, where you say, I'm going to be rich, I'm a genius, I've made so much money. And then naturally, right, the pendulum swings too far, and then things start to correct, and then it becomes complacency. Well, things are going to cool off. We're going to, got to consolidate for the next rally. And then there's, things continue to go down. There's some anxiety, goes down further. There's denial. My investments are great companies. They're going to come back. Then there's panic, right? If it keeps going down, oh my God, everybody's selling, I need to get out. And then further than that, there's capitulation, and then anger, and then depression, and eventually acceptance. And then we start the next rally. This point here where everyone is very fearful, upset, depressed, a lot of negativity, that's generally the point of maximum financial opportunity. And the point of maximum financial risk is when everyone thinks making money in the market is easy. It happened in the 90s, it happened during the pandemic, and it will happen again in the future, right? It's just the cycle of markets. So every investor needs a game plan, right? So this is all about trying to controlling what we can control. So one of the first constraints you need to think of as an investor is, what is your time horizon? And I would write it down. You want to clearly define your time horizon based on the specific goal you're trying to achieve. Short term, I would say, is 0 to 2 years. Medium term, 3 to 7 years. And longer term is 10 plus years. The shorter the time period, the less risk you can afford to take. And the longer the time period, the more risk you can afford to take, because you can afford to ride it out. Liquidity needs is how much money are you going to need from the portfolio on an ongoing basis, right? If you're going to need money from the portfolio over the next 2-3 years, right, you should not be taking much risk with the amount of money you're going to need over those next 2-3 years, because no one knows where the market's going to be in 2-3 years. The lower the liquidity risk, right, if the money's not going to be needed until years 10 through 15, then you can afford to take more risk, right? Because that's a much longer time frame. Think back 10 years ago, it was 2012, right? People were still terrified of investing because they were still, had scars and bad memories of the decline in 2008 into 2009. A lot's changed since then, and the market's much, much higher now than it was then. The other thing is your risk tolerance. This is one of the hardest things as advisors to capture with the client, because you really don't know how you're going to react to risk until you're in a situation where, we're in a drawdown like we are now. Risk tolerance is the amount of volatility in your portfolio that you can endure without losing sleep at night or going to cash. And I would try as much as possible to spend time really thinking through, what is my risk tolerance? How comfortable would I be if my portfolio was down 10, 20, 30% over the next 1 to 2 years? And if the answer is I wouldn't be comfortable at all, then you probably need to reduce your equity exposure. Required rate of return, right? What rate of return do you actually need to achieve your goals, right? A lot of people don't know. They may, if you look at their plan and their cash and what they're going to need from the portfolio, they may only need a 3% rate of return to reach their goals. Some may need a 5 to 6% rate of return or more, right? But knowing your rate of return is the result of going through a plan and actually putting pen to paper and looking at the numbers. It may be, if you only need a 3 to 4% rate of return, but your portfolio is allocated, 80, 90% to stock, you're taking far more risk than you need to. And, you may have regrets if you don't make things more conservative, because if your portfolio is 80, 90% stock, you could easily be down, 20, 30, 40% in a year. And then you're thinking, oh my God, why did I take all this risk? I didn't even need this. I didn't even need that much of a return in order to reach my goals. And then the asset allocation, right? The actual investments that you how you allocate your portfolio should be based on these 4 parameters. And we use what we like to call a bucket approach, which we'll go through here now, as a template for broad asset allocation decisions. So, I mean, anyone can go through this for themselves, but the first question is, how much money do you need to withdraw from the portfolio each year, right? Multiply whatever that number is by 7 or 10, which would equate to about 7 to 10 years worth of expenses. The idea there is we want to try to set aside that amount of money of withdrawals where it's not invested in stocks, so that you don't have to rely on stock market returns to fulfill your lifestyle, right? So that portion of the portfolio should be relatively stable, produce maybe modest income. So, for example, if you expect to pull $300,000 out of your portfolio over the next 7 years, and your total portfolio value, right, your total investment value is $1 million, then a 30% allocation to fixed income, in our opinion, would be sensible. Now, risk tolerance then kind of comes in, and if that same person, let's say they're retired, is very conservative and they can't tolerate market volatility, and they know that they're not going to be able to withstand it and they're going to lose sleep at night, then that percentage can be moved up to account for 10 or even 15 years of expenses, right? So obviously that would mean there's a lot more in the fixed income cash sleeve of the portfolio, which would overall lower the return over time, but would also make for a less volatile path for that client. And on the return side, right, in this example, there would be a 70% allocation to stocks, and that's going to drive the majority of the portfolio's return. By not being forced to sell stocks each year to meet expenses, the stock portion of the portfolio can earn larger returns over long periods of time, with the goal of outpacing inflation. And there's always going to be this balancing act between risk tolerance, required return, and portfolio withdrawal needs in any given year. Lastly, a bear market like we're going through now can significantly disrupt this long-term plan if one sells out of stocks at a low point, right? So it is critical to understand the purpose of different investments in your portfolio. Diversification and asset allocation, right? Different parts of the market react differently to exogenous shocks. So you want to diversify across asset classes and investment strategies to lower your overall risk as measured by volatility, right? Everything should be looked at through the lens of risk reward, right? You can't have reward without risk. So you want to try to identify situations where the reward is greater than, the unit of reward you're getting is greater than the unit of risk you're taking. So you have some asymmetry there. I think it's one of the most overlooked and important principles of investing. How much risk are you taking per unit of reward? The higher the reward relative to the risk, the more attractive the investment opportunity, right? And remember, volatility is the price you pay for high returns. You can't have one without the other. So within asset classes, right, you can invest in bonds, equities, commodities, real assets like real estate or other property, and cash. Thank you so much for attending this webinar. If you have any questions, feel free to email us, info@4jwealth.com. Again, I'm Josh Goulding, and I look forward to seeing you for the next webinar. Thank you so much and have a great day.